So hello from Basel and welcome to our last quarterly review of 2021. I'm joined this morning by Claudio Borio, who's head of the Monetary Analysis and Economics Department, and Hyun Song Shin, Economic Advisor and Head of Research. So the document itself will be released under embargo at 1 p.m. CET today, and we will take your questions after a few short remarks from Claudio and Hyun. So Claudio, please, over to you.
Well, thank you very much, Jill, and good morning and good afternoon to everyone. As you have no doubt noticed, this quarterly has a special focus on non-bank financial intermediaries, or MBFIs. This sector includes investment funds, asset managers, and institutional investors. It has a growing footprint in the financial system and has in fact grown much faster than the banking sector over the past decade. Financial assets of the NBFI sector totaled 200 trillion in 2019, accounting for nearly half of the global financial system. NBFIs provide a valuable source of alternative financing, but they also give rise to new channels of financial instability. In the foreword, our General Manager, Agustin Carstens, outlines the need for a system-wide policy approach, drawing on the experience of regulatory reforms in the wake of the great financial crisis. To quote Agustin, "Those reforms strengthen banks and reduce their systemic impact. It is time to apply a macro-prudential approach to NBFIs as well. One element of the response should be better information through stronger monitoring, enhanced regulatory reporting, and public disclosures. Another should be to ensure that NBFIs build war chests in good times in order to mitigate collective retrenchment in times of stress. Ultimately, a more consolidated supervisory perspective would be necessary." The quarterly also examines recent financial market developments from 13th September to 29th November 2021. Overall, investors' risk appetite proved resilient in advanced economies. That said, at end November, concerns about the new virus variant curtailed the stock market gains. They also accelerated an uptick in credit spreads, which nevertheless remain compressed by historical standards. Moves in government bond markets during the period under review illustrated that MBFIs can have material effects even on the US government yield curve, the focus of monetary policy, and a crucial benchmark for the pricing of assets around the globe. At end October, an apparent disconnect opened up in government bond markets between central banks' guidance and front-end rates. In the review period, financial conditions tightened further in several emerging market economies, where monetary authorities continued to fight persistent inflationary pressures. US dollar strength added to this tightening. And now let me turn to Hyun.
Thank you, Claudio. Let me turn to the special features. The special features in this quarterly review delve into selected aspects of the MBFI ecosystem, which address both old and new issues. So as an example of the new issues, the piece by Aramonte, Huang, and Schrimpf analyze decentralized finance, or DeFi. Now, DeFi refers to financial intermediation that uses automated transactions that are executed on the blockchain. And even though links with traditional finance are currently limited in scope, DeFi warrants closer monitoring because of high leverage, limited shock-absorbing capacity, and built-in interconnectedness. The other pieces examine old issues in new settings. Claessens and Leverick discuss the systemic risks and policy implications of open-ended bond funds. These open-ended bond funds hold assets with varying liquidity, but redeeming investors are promised immediate liquidity. During recent episodes of stress, redemptions and asset sales by these funds impaired system-wide market liquidity. And the authors stress the need for macroprudential tools to bolster the resilience of open-ended funds. There is a piece by Maguire, Shim, Shusko, and myself that focuses on dollar funding issues that arise from the currency hedging of asset managers from several emerging Asian economies. Institutional investors in these economies have grown in size and hold portfolios that span global markets, including long-term assets denominated in US dollars. They hedge currency risk from these asset holdings, but the supply of hedging services come from banks through mainly short-term instruments. This maturity mismatch between long-term hedging demand and short-term hedging supply means that MBFIs are vulnerable to US dollar funding disruptions, as happened in March of last year. And this piece examines the policy responses since then. In another piece, Aramonte and Avalos examine how private capital markets have become a global force for corporate financing and restructuring. Among emerging market economies, the footprint of private capital firms is particularly strong in Asia. The authors find evidence that US private capital firms add to procyclicality of financial conditions. Finally, we have a feature by Skatinya, Shah, Zabai, and Zulaika, which explores the pricing of green and other sustainable financial assets. They find that bonds from firms with larger carbon emissions trade at somewhat higher yields. On the other hand, social bonds are less expensive at issuance than conventional bonds. The authors discuss how markets have been coping with disclosures and taxonomies, which emerge as important issues in the desired transition.
Thank you very much, Hyun. And we'll now go to questions. I suppose as this feature has non-financial firms as its special focus, I propose to take questions first on non-banks, and then in the second part of the briefing, we'll take questions on developments in financial markets from our review. So I'll pause now. There are two ways to ask questions. I think you know the drill by now, which is raise your hand if you want to call in your questions. And then secondly, type your question into the chat. And as I said, we'll start with questions on non-bank financial firms first. So I will hold while you get ready. So we have a hand raised from Paul Davies from Bloomberg. Paul, please ask your question.
Hello. Sorry. So two questions. One on DeFi. I'm just curious to know, to what degree do you think institutional investors have become involved in these markets already? Have you got any sort of data on that, and what have you seen there? And does this add to any concerns about the possibility of spillovers into other markets? And then secondly, sort of a government debt-related question in terms of liquidity at times of, like in March 20, in the examination of the Treasury market. One of the things that people are starting to think about is a central bank having to add as a market maker of last resort all the time, just because of the sheer size of the market and how much it can move. Which is obviously, this is related to activities of non-bank financial institutions in the markets and so on. What do you think about that? Do you think we're going to end up in a world where central banks are market makers of last resorts in general? Thanks.
Thank you very much, Paul. Maybe suggest the first question I think Hyun will take on DeFi, and then the second one by Claudio. Thank you.
Yeah, thank you, Paul. I think as we say in the special feature, as the authors say in the special feature, I think the size of the market is still fairly small, and I think we are at a fairly early stage. And the interconnections and the points of contact with conventional markets are still relatively small at the moment. But this is clearly something that we will need to monitor very closely. And as we say as the authors say in the special feature, There is a sense that these markets tend to be self-referential in the sense that many of the innovations tend to be geared towards making trading, of the various tokens within the ecosystem, easier, rather than really spreading out according to the other conventional parts of the financial system.
Well, thank you for that question. I think the place to start is that financial markets have indeed grown a lot since the great financial crisis, but this is a trend that predates that. As a result of that, the techniques that central banks have to use in order to stabilize the financial system have to adapt. So we saw, and indeed we discussed this in some detail, not in this year's annual economic report, but in previous year's annual economic report, there has been a shift towards the standard lender of last resort provision of liquidity to a more active intervention in markets. Having said that, and this is the key point of the quarterly review, this issue, is that it is extremely important to avoid this condition, these interventions, repeated interventions of central banks take place, because these interventions have clear side effects in terms of risk-taking, in terms of the allocation of resources in the economy. And as a result of that, it's precisely because of that that we need to strengthen the regulatory framework that NBFIs are subject to, because they are key players in these markets.
Thank you very much, Claudio. The next raised hand is from Jack Schickler from MLEC. So, Jack, if you can come in with your question, please.
Thank you. Two questions as well, if I may. Firstly, your sort of main conclusion of the paper on decentralized finance is that will only work, it can only be regulated if it is centralized, which presents a bit of an oxymoron. So I guess my question is it possible to centralize it enough in order to regulate it while still retaining the benefits of decentralization that is the promise of the technology? Or is there some other innovation that needs to take place to square this circle? And my second question is just on non-bank financial intermediation, when you expect this regulation to happen, what is the timetable ahead?
Thank you very much, Jack. So I think we'll start with Hyun on the first question about centralized DeFi, and then to Claudio. Thanks.
Yeah, thank you, Jack, for that question. I think you do raise a very important point there. The issue is to what extent we can automate transactions and remove the discretion that normally comes from an ex-post, reevaluation of the contract, as it were. I think there is a sense. I think one can go a long way towards automating transactions, and automation does have benefits. For example, when we have security settlement, there are issues such as payment versus delivery, payment versus payment, that removes counterparty risk and makes the system function better. But the point that raised in the special feature is that there's a limit to how far you can run a whole financial system purely based on those automated transactions. There will be occasions when judgment, when some kind of ex post reorganization or judgment will be needed. And I think it's still an open question how far this project can be pushed without that kind of centralized guidance. And I think that's something that we will clearly need to watch very carefully. On the regulation, I think there are possibly three entry points into this question. One is the issue of consumer protection and guarding against money laundering and other illicit activities. That's more of a kind of conduct issue. Then there is the issue to do with financial stability, to what extent the ecosystem will connect with the conventional financial system. Then there is the issue of how do we think about these new institutions, these new arrangements as part of the financial market infrastructure. And of course, there, the BIS, through its Committee on Payments and Market Infrastructures, also has a very important role to play. So we're still in very early days, so I don't think we can, come to any firm conclusions. But there are some very important questions there for sure.
Thank you very much. We have another hand up, which is Bjark Smith-Meyer from Politico. Bjark, if you want to call in your question. Thank you. Bjark, have you got the question?
Yeah. I just managed to mute myself at the same time.
No problem.
Thanks for taking the question. As part of it was answered there from Jack. But I mean, there are more and more lobbyists for DeFi arriving in Brussels. So I'm constantly getting a lot of the lobby talk. So I'm just sort of curious to sort of know. I mean, I was looking through the report on this, and there was sort of a concern about a concentration of power. I'm just wondering if you could. I mean, you mentioned money laundering concerns, but I'm just wondering if you could give me an idea of what are the main concerns that you think could arise from allowing DeFi or decentralized finance to kind of not run riot, but really kind of grow. I think that's, I mean, you answered, regulatory approaches to this, but if you have anything more to add to that, then I'm all ears. Thank you.
Okay, Hyunal's going to take that question. Thanks, Hyun.
Yeah, thank you, Barker, for that question. I'm not sure that there's much to add beyond the special feature here. And the question that's raised, in the piece is to what extent these arrangements are genuinely, decentralized. And after all, the decentralization agenda, came about primarily for, governance reasons. It was a way to remove central intermediaries, remove the need for a trusted, counterparty, and have everything done in a purely decentralized way through the blockchain. In practice, as the special feature says, there is a lot of influence by a small number of very large players, and I think the question that it raises is to what extent are we reintroducing intermediaries just through a different name.
Okay, thank you very much. We have a question from Amélie Laurent from Les Echos, and she's asking, asset managers are already regulated by national market regulators or regional regulators, such as ESMA in Europe. So her question is asking, does this regulation not go far enough, and on which issues? And what's our position in the debate on the systemic role of the largest asset managers? Are they SIFIs, so significant financial intermediaries? So SIFIs, I should say, SIFIs. Thank you very much. So Claudio will take this question. Thank you.
Well, thank you, Jill. The key point that we're making in the forward, we're making the various special features, is that it is important to have a system-wide, systemic or macroprudential approach, if you like, to the sector. So far, the regulations are primarily designed to support, protect the investor, and even to the extent that they deal with individual institutions for trying to avoid fire sales and the like, they take too much the perspective of individual firms, as opposed to dealing with the fact that even if a firm, even if an asset manager, investment vehicle, it in and of itself is in relatively good shape, if all the various entities try to pull back at the same time, this can create problems for the financial system as a whole, as we saw, for example, in March. Now, this perspective, this so-called macroprudential perspective, was applied to the banking system in the wake of the banking crisis. During the, I'm talking about the 2007-2009 crisis, great financial crisis. But it hasn't yet been applied to this other sector. And we know that this sector has grown a lot. Its heft in the global financial system has increased. And there is a need to deal with the sector precisely from the same perspective. And there are efforts underway, and we are effectively encouraging those efforts to go further.
Thank you very much, Claudio. And Chris Flood is indicating that you want to ask, I think, a question on MBFI war chests. So Chris, if you want to ask your question, please come in. Or if not, type it into the text. So Chris will give you a moment to unmute.
Hello.
There you are. Hello.
Thank you very much. When you talk about NBFIs having to build up their war chests in good times, all of the discussion then goes on to talk about measures that only bond funds should take. But I mean, are you also suggesting that other NBFIs, asset managers, at a group level, at an entity level, should be increasing war chests in order to deal with periods of stress? Because it's not at all obvious how the framework that you're suggesting cascades down across all of the different types of investment funds that regulators are looking at. It's not at all obvious how a money market fund, for example, which are subject to runs, as we know, can build up a war chest.
Thanks very much, Chris. I'll hand that question to Claudio, please.
No, indeed, very simply put, the arguments that we make do not just apply to money market funds. They apply to the whole set of non-bank financial institutions. Now, these institutions are subject to different types of regulation depending on which type of institution they are. For example, insurance companies have been subject to regulation for much longer, or a different type of regulation with a much more prudential angle. So the point that we're simply making is that we need to apply a system-wide approach, a macroprudential approach, also to other types of financial intermediaries.
I think Hyun wants to come in on that as well. Hyun?
Yeah, Chris. I think the term war chest, you should take it in a broader sense. I mean, the point here, as Claudio just explained, is the perspective and the system-wide perspective rather than any particular set of regulations. And the question is really about how do you mitigate the spillover effects of one set of institutions to the broader market. So that could take many different forms. The special feature on bond funds has one particular focus, and it's very much taking lessons from what happened last March. But the issue on the perspective, on the systemic perspective, I think is pretty general, I would say.
Okay, thank you, Hyun. Vikram, I was about to come to you because you had a raised hand from the Straits Times. Do you want to come in? We see you've lowered your hand, so not sure. So I might pause there to see if there's any more raised hands or if any more questions on the chats on the NBFI topic. So Sharon Theoruchev-Velam has a question from Risk.net. Sharon, do you want to come in with your question, please? Just unmute yourself, Sharon.
I do.
Hi.
Okay, great. So it's a question actually on the last paper on ESG, and the authors concluded that any ESG designation requires reliable taxonomy, and that those taxonomies be standardized, and it refers back to work at the G20, wondering whether BIS sees a role for itself in this process, and also given the sort of the working group through the G20, the IPSF that's working on taxonomies has just a few members at the moment, not as many as one would need for such a taxonomy to be standardized globally. I'm just wondering the BIS's view on whether membership would need to be increased, more jurisdictions would need to be brought into the conversation.
I think Hyun can take that question. Thank you, Sharon.
Yes, indeed. Thank you, Sharon, for that question. There are a number of multilateral settings where the disclosures and the taxonomy surrounding sustainable assets are being discussed. As you mentioned, the G20 is one such setting. The BIS already plays a role through the Sustainable Finance Working Group, which is a very active part of that setting. There's also the central bank grouping that has the name the Network for the Greening of the Financial System, and the BIS plays a role there as well. So we've been, of course, very closely focused on some of the taxonomy and some of the disclosure issues, which we think is an important precondition for giving greater operational, if you like, leverage to operational, if you like, substance to the whole agenda. So I would say that we are already playing a part, but of course, we are not the only players here. There are many other important stakeholders.
Thank you very much, Hyun. We have another question in the chat from Amélie Laurent from Les Echos, who comments, you say that efforts are underway for systemic-wide and macro-prudential approach of NBFI, and what initiatives are we referring to, or what is meant by that? So, Hyun, you can take that. Thank you.
Yeah, thank you, Amélie. There is a fairly extensive work program on MBFIs under the Financial Stability Board grouping. This is, you may have seen the FSB's report last November on the holistic approach, on the holistic assessment of the events of last March. And if you go to the FSB's website, there is a fairly good summary of the work program. We are right in the middle of that. It's the FSB, as you know, is an umbrella organization that actually includes not only the central banks, but the securities regulators and other official sector participants.
Okay, thank you very much. I think we've gotten all the questions on NBFIs. So without any further hands on that, we might move then to the topics in financial markets. And we have a question waiting from Assis Moreira from Valor Económico. And the question is about, could we elaborate about clouds on the horizon for EMEs? And the question is answered in the context of Brazil, but I think we could answer the question more broadly. So please, Claudio.
Well, thank you. As we analyzed in a lot of detail in the annual economic report, which came out in June, emerging market economies are more vulnerable than, in general, as a general statement, than advanced economies to developments. All countries went into the crisis at the same time, but they have been emerging from the crisis at very different speeds, depending on two factors. First of all, the virus, the evolution of the virus, and secondly, the room for policy maneuver that these countries have. And the reason why emerging market economies, on average, are more exposed to than advanced economies is because they are the room for maneuver is generally smaller, and because they are more vulnerable to changes in global financial conditions. Now, again, the emerging market world is in fact very heterogeneous. And the countries, for example, in Latin America, are more exposed because they have a longer history of inflation, and that's why the authorities have already had to tighten in order to address the problems there. And on average, they also have weaker fiscal policy positions. And that's precisely why we argue that they're more vulnerable. In fact, financial conditions in general have already started to tighten and tighten further during the period under review.
Thank you very much, Claudio. We have hands raised now. So Mark Jones from Reuters, if you could unmute yourself. I can hear you loud and clear. Maybe just adjust your sound a bit downwards. Okay, perfect, Mark.
Oh, all right. Is that better? Great.
Yeah.
So just I wonder if you could give a little bit more colour on Omicron and the risks that it poses. I guess in combination with central banks looking to potentially raise interest rates next year, and also just a second question. You make the point in that report about the Chinese currency basically having withstood the pressures of a slowing economy and certain challenges such as the property market. And this morning, the central bank has cut the RRR again. So yeah, just a bit more view maybe why the currency has withstood some of those pressures.
Thank you very much, Mark. And just to check, just that we heard you correctly, you were asking about more colour on the risks that Omicron poses. Just to be clear, we heard you properly.
Yes, exactly.
Okay,
if there's anything else you can say on that, just
okay.
how much volatility it could potentially bring, for example.
Sure. Okay. All right, Claudio, please.
Yeah, I'll take the first part, and then Hyun can develop on the exchange rates. Well, first of all, I think that the emergence of Omicron indicates that we should not lower our guard. I think that for some time, also in financial markets, the view had taken hold that the virus situation in general, the pandemic, had come under control, and this was the latest reminder that we have to be watchful and that unexpected events can take place, can happen. As regards the impact of Omicron in particular, so far the view is that it's still a bit early days because we have to understand also how serious the impact of Omicron is on health. We already know that it can spread much faster, and as you have seen, authorities have already started taking measures. Now, the central expectation is, however, that the authorities have learned quite a lot from previous experience in terms of how to tailor the restrictions so as to limit their impact on economic activity. So as of now, the central scenario of a recovery has not been adjusted. But having said that, of course, we will need to see exactly how the evolution of the virus is, and therefore the possible impact on economic activity. Some impact is inevitable, particularly in the first quarter of 2022. But let me turn to Hyun for the other part.
Yes, thanks, Mark, for that question. If you have the quarterly review in front of you, if you look at graph 7 of the overview, which is page 19, what we point out in this passage is that emerging markets as a group have, faced challenges in terms of capital flows. Although they do borrow in domestic currencies, we have seen fairly subdued inflows into many emerging markets, and the exception here really is the Asian economies that you see here on graph 7, and in particular, if you look at the right-hand panel, it's China in particular. So China has been the exception, and there has been sort of fairly sustained flows. I think that certainly had, I think the sense that the emerging markets as a group, is not a homogeneous group, I think, really does come through here.
Thank you very much, Hyun. We have a hand raised from Aaron Lester from Environmental Finance. Aaron, do you want to call in your question?
Yes, thank you. Can you hear me?
Perfectly, yes, thank you.
Oh, marvellous, thanks. I've got a couple of questions related to the interesting special feature covering green and social asset pricing, in particular around the social aspect. First, the research sort of indicates that the social seems to be quite pronounced at about 12 basis points. Is there a sort of a worry that there's a social bubble in the social bond market? And second, it's also interesting that the Japanese yen and Korean won markets didn't experience a social, unlike US dollar and euro markets. I mean, why do you think that is the case, that the pricing experience is so different?
Okay, I think both offering to answer it. So Claudio maybe first, followed by Hyun.
Yeah, I'll take at least the first part. Yeah. So on the first part, I think that one needs to stand back a little bit and understand what the possible financial implications of the transition to a green economy are. What's peculiar about the transition is that normally when you think of financial instability, you think of an overall overextension of the financial system. And financial instability arises when the financial system and the economy are out of sync. Think, for example, of financial booms and financial busts. Now, in the case of the transition, the problem is different, because what you need is an orderly sectoral shift from sectors that are more pollutant to those that are less pollutant. As a result of this, you can have problems in both sectors. Now, the general attention so far has rightly been focused on so-called brown assets and legacy assets and the stranded assets, the fact that assets of the polluting sectors could lose value quite suddenly. But there is, of course, the other possibility, and the other possibility is the one that we drew attention to in the quarterly review, in the previous issue of the quarterly review, which is the so-called green bubble. Now, I don't think that you can infer anything from the current special feature on whether there is a bubble or not. What we did stress in the previous issue of the quarterly review is that so far, the biggest changes that we have seen, the possible signs of overvaluation have mainly been on the equity side. The information on the bond side is still insufficient to exactly evaluate the situation. But most importantly, it is always difficult to tell whether there are bubbles or not. And because so far the issues have been primarily in the larger equity sector, that is the sector that tends to be less important from the point of view of financial stress. But let me turn to Hyun to complement the answer.
Well, not much to add to that. I think that was a very good answer. Yeah.
Thank you very much, both of you. So we don't see any further hands raised or any more questions in the chat. I'll pause for a moment just in case there are any last-minute hands raised. Is Bjork raising your hand again?
Yeah.
Yeah, please come in.
No, I'm just if I could just ask for a practical example on DeFi again, and sorry for coming back to this, but is Hyun or anyone else, if you could just give me a sense as to, how is it, for example, that a bank can prove to be a shock absorber that would be amiss inside of a DeFi setup? Just, I don't know, it's sort of concrete example as to how a bank would sort of, be able to deal with any issues there. Thank you.
Hyun, is that something you can answer?
Not quite sure what you have in mind, Bjarke. Could you just elaborate a bit more?
Yeah, no, I'm just sort of picking this out from the text, and now I'm just trying to find it again. But there was this sense as to the fact that DeFi doesn't have shock absorbers. And here, the crypto ecosystem lacks internal shock absorbers, such as banks that can provide liquidity at times of stress. And I'm just sort of, I don't know, if you could give me a war game, like, how is it that this could sort of, what could happen within the DeFi ecosystem that, would benefit from an intermediary like a bank? I'm just looking for, a war game, a practical example that I can explain to laymen.
Yeah, I think, Bianca, maybe the best way to think about this is to lay out what banks do during stress times. So this is very much what a conventional financial intermediary can do. And if we go back to March of last year, there was a huge increase in the deposits of the economy. So they were, if you like, the deposits created by the commercial bank system in response to sharp stress and the increased demand for liquidity. And that increase in deposits came about because of the drawing down of credit lines. So if you have an arrangement with a bank and you have the possibility to have an overdraft, with that bank, and you have a sudden need for cash, you would then call on that overdraft facility. And in that respect, banks are a very good example of what we call elastic nodes in the financial system. So they allow the system to respond in a very elastic way, in a very resilient way. And of course, the central bank is the best example of a very elastic node, in that the central bank, just like a commercial bank, can engage in this kind of asset purchase, increase the amount of cash in the system that plays this buffering role. So I think the point the authors were trying to make there is just that this kind of role is very much already hardwired into the current conventional financial system.
Thank you very much, Jon. Mark Jones has a hand raised. Mark, do you want to come in with another question? Just giving you a moment, Mark, if you want to come in. I think you're unmuted now. Okay, we're hearing you. It's a little bit of background noise, Mark. Can you hear us? Mark, we're hearing background noise, but not you. We can see you're unmuted.
Good.
Now we
hopefully
can.
You can hear me. Yes,
perfect.
great.
Yeah.
It was really the second part of my first question. I also kind of touched on that idea of some of the central banks looking to raise interest rates, and it seems they're getting slightly more keen on the idea. And it just wanted to get the idea of what the feeling is about that now. I mean, is it slightly more risky with Omicron, or should we just press ahead for now, at least, considering the inflation outlook?
Okay, I think Claudio can take that, Mark.
Well, thank you. It's difficult to tell. Obviously, in the short run, the new virus could actually, on the one hand, exacerbate some of the inflationary pressures in the short run. That's simply because if measures are taken to suppress production in order to deal with the virus, well, this could actually exacerbate bottlenecks. At least this is in the short run. At the same time, it could put some downward pressure on economic activity. And this, of course, makes the trade-offs that central banks are facing slightly more complicated than they were before, where all the pressures were on one side, with economic activity growing and inflation rising. But clearly, this is something that central banks are used to. There is nothing new here, and they will be calibrating their policies accordingly.
Thank you. Claudio, I see Aaron Lester has a hand raised again. Just wondering if that's the same hand from earlier or a new hand.
No, it's a new hand.
Okay, thank you very much.
So returning to the same sort of feature, if I may. I mean, as I said, I mean, it's interesting that the Japanese yen and Korean won markets didn't experience a socium, unlike the US dollar and euros. Does that tell us anything interesting about labelled social bond markets and these different currencies? And any thoughts would be interesting. I mean, I know you said that it's perhaps early to draw any firm conclusions, but does it perhaps indicate potentially worrying pricing trends in Europe and the US for social impact assets?
Hyun?
I'm not sure that we can, draw any, any insights that are, very general at this stage. I think suffice to say that the international role of the dollar means that that is the largest market. But I wonder whether, I mean, on this particular question, we can certainly put you in touch with the authors. And if you have some specific issues that you want to drill down, we can certainly do that for you.
Yep. So Aaron, how about maybe we connect with you after the session and can offer that? And I think the same goes to anybody else who wants to really dig deep into a topic. We can also arrange a background briefing with the authors as well. So I think we have all questions answered, and I think we've gone a bit over time today, so thank you very much, everybody. We will be back in the new year with the next quarterly. Thank you for your time. As we said, it will be released under embargo in just about an hour's time from now. And we wish you all season's greetings, and we will see you in 2022. Stay safe and take care.